Hey everyone! Welcome back to Investors Insight 2.0, your go-to channel for smart investing, economic updates, and cutting-edge insights into the world of finance and technology. Bitcoin, the pioneering cryptocurrency, has experienced a meteoric rise since its inception in 2009, capturing the attention of investors and the general public alike. As a decentralized digital currency, it has revolutionized the way we think about money and transactions. However, this innovation has not come without its share of skepticism. Warren Buffett, often regarded as one of the most successful investors of all time, has consistently maintained a clear stance against Bitcoin, viewing it as a speculative asset devoid of intrinsic value. His investment philosophy is grounded in the principles of intrinsic value and cash flow, which he believes are essential for evaluating any investment. Buffett argues that Bitcoin does not produce cash flow or dividends, making it fundamentally different from traditional investments like stocks or real estate, which generate tangible returns over time. This perspective is shaped by his historical successes, where he has focused on companies with strong fundamentals, solid management, and sustainable competitive advantages. In stark contrast, the emerging cryptocurrency market, with its volatility and speculative nature, presents a different investment landscape. While many investors are drawn to the potential for high returns in Bitcoin and other cryptocurrencies, Buffett remains skeptical, viewing them as risky ventures that lack the stability and predictability he seeks in his portfolio. He often emphasizes that investing should be based on sound principles rather than speculation, warning that the allure of quick profits can lead to significant losses. This divergence in investment strategies highlights the broader debate between traditional investing and the new wave of digital assets. Charlie Munger, the vice chairman of Berkshire Hathaway and Warren Buffett's longtime partner, has been notably blunt in his criticism of Bitcoin, famously labeling it rat poison. Munger's perspective reflects deep concerns about the ethical implications of cryptocurrencies, which he believes can facilitate illicit activities and contribute to financial instability. He argues that Bitcoin's lack of regulation and oversight poses significant risks, not only to individual investors, but also to the broader financial system. Munger's investment history, characterized by a focus on value and ethical business practices, informs his skepticism towards cryptocurrencies. He has consistently advocated for investments in companies that contribute positively to society, contrasting sharply with the speculative nature of Bitcoin and its peers. Munger's statements carry weight and influence public perception of Bitcoin, particularly among conservative investors who may view cryptocurrencies as risky and untrustworthy. His strong rhetoric serves to reinforce the notion that Bitcoin is not a legitimate investment but rather a dangerous gamble. This perspective resonates with those who prioritize stability and ethical considerations in their investment choices, potentially swaying public opinion against the burgeoning cryptocurrency market. As Munger continues to voice his concerns, it raises important questions about the future of Bitcoin and its acceptance in mainstream finance. His critiques highlight the need for a more comprehensive understanding of the ethical and practical implications of investing in digital currencies. By examining Munger's rationale, we gain insight into the broader skepticism surrounding Bitcoin and the challenges it faces in gaining legitimacy among traditional investors. Bitcoin's performance over the past decade has been nothing short of remarkable, with its price skyrocketing from mere cents in 2010 to an all-time high of over $60,000 in 2021. In comparison, Berkshire Hathaway, led by Warren Buffett, has also seen substantial growth, with its stock price increasing significantly over the years. However, Bitcoin's meteoric rise has led some to label it as a superior asset, particularly in the context of its potential for future growth. Proponents argue that Bitcoin's limited supply, capped at 21 million coins, positions it as a unique asset that could appreciate further as demand increases, especially in a world increasingly leaning towards digital currencies. Moreover, Bitcoin is often discussed as a hedge against inflation and the inherent flaws of traditional currencies. With central banks around the world engaging in expansive monetary policies, concerns about currency devaluation have grown. Bitcoin's decentralized nature and scarcity make it an attractive alternative for those seeking to protect their wealth from inflationary pressures. This perception has fueled interest among investors looking for assets that can withstand economic uncertainty. While traditional investments like stocks and bonds have their merits, Bitcoin's volatility and potential for high returns have drawn a new class of investors eager to capitalize on its growth. As we analyze Bitcoin's performance relative to traditional investments, it becomes clear that its perceived value is shaped by both its historical price trajectory and its role as a potential safeguard against economic instability. This duality makes Bitcoin a compelling topic of discussion in the evolving landscape of finance. The concept of the silent tax refers to the gradual erosion of purchasing power that occurs due to inflation, which disproportionately affects savers. This phenomenon means that as prices rise, the value of money held in savings accounts diminishes, leading to a loss of wealth over time, without any explicit tax being levied. For instance, if inflation rates hover around 3% annually, a saver with $10,000 in a bank account will find that, after a decade, their money will only have the purchasing power equivalent to about $7,400. This subtle yet impactful decline can significantly hinder long-term financial goals, such as retirement or buying a home. Historically, currency devaluation has been a recurring issue, often driven by government policies, excessive money printing, or economic crises. For example, during the hyperinflation in Zimbabwe in the late 2000s, citizens witnessed their savings become virtually worthless overnight, leading to widespread financial instability and loss of wealth. Such events underscore the challenges of preserving wealth in traditional currency systems, where the value of money can fluctuate dramatically due to external factors. Traditional currency systems also exhibit inherent flaws, including reliance on central banks and government policies that can lead to mismanagement and loss of trust. These issues highlight the need for alternatives that can provide a more stable store of value. Cryptocurrencies like Bitcoin have emerged as potential solutions, offering decentralized options that are less susceptible to inflationary pressures. As the limitations of traditional currencies become increasingly apparent, the search for viable alternatives becomes more urgent, prompting discussions about the future of money and wealth preservation. Satoshi Nakamoto, the enigmatic figure behind Bitcoin, emerged in 2008 with the release of the Bitcoin white paper, outlining a revolutionary digital currency designed to operate without a central authority. Despite extensive speculation, Nakamoto's true identity remains unknown, leading to various theories about whether it is an individual or a group of people. The motivation for creating Bitcoin stemmed from a desire to establish a peer-to-peer electronic cash system that could empower individuals by providing an alternative to traditional banking systems, particularly in the wake of the 2008 financial crisis. At the core of Bitcoin's design is its decentralized nature, which means that no single entity controls the network. Instead, transactions are verified by a distributed network of computers, known as nodes, ensuring transparency and security. Additionally, Bitcoin has a maximum supply limit of 21 million coins, a feature that distinguishes it from fiat currencies, which can be printed in unlimited quantities by governments. This scarcity is intended to create a deflationary environment, potentially increasing Bitcoin's value over time as demand grows. Bitcoin offers several advantages over traditional currencies, including lower transaction fees, faster cross-border payments, and protection against inflation. Its decentralized structure allows users to transact directly without intermediaries, reducing costs and increasing efficiency. Furthermore, Bitcoin's global accessibility enables individuals in underbanked regions to participate in the financial system, fostering financial inclusion. As we explore the foundational principles of Bitcoin, it becomes evident that Nakamoto's vision has the potential to reshape the future of money and empower individuals worldwide. Bitcoin's unique characteristics, particularly its pseudonymous nature, have sparked contrasting views regarding its potential for promoting financial freedom versus its misuse in criminal activities. On one hand, Bitcoin offers legitimate users a means of conducting transactions without the oversight of banks or governments, providing a level of privacy and autonomy that many find appealing. This anonymity can empower individuals in oppressive regimes, allowing them to bypass censorship and access financial resources without fear of reprisal. However, this same feature has also attracted criminals who exploit Bitcoin for illicit activities, such as money laundering, drug trafficking, and ransomware attacks, leading to a perception that cryptocurrencies are inherently linked to crime. The ethical implications of a currency that operates outside the control of authorities are significant. While the decentralization of Bitcoin can be seen as a triumph for personal freedom, it raises questions about accountability and the potential for misuse. The lack of regulation means that there are fewer safeguards in place to protect consumers from fraud or scams, which can undermine trust in the system. Finding a balance between the financial freedom that Bitcoin offers and the risks associated with unregulated currencies is a complex challenge. Advocates argue that with proper regulation, the benefits of Bitcoin can be harnessed while minimizing its potential for abuse. Conversely, critics warn that excessive regulation could stifle innovation and limit the very freedoms that Bitcoin was designed to promote. As the debate continues, it becomes clear that navigating the dual nature of Bitcoin requires careful consideration of both its empowering potential and the risks it poses to society. The market dynamics of Bitcoin are primarily driven by the principles of supply and demand, which significantly influence its value. As interest in Bitcoin grows, so does its price, reflecting the increasing demand from both retail and institutional investors. Widespread adoption is crucial for Bitcoin to stabilize and reach its full potential as a mainstream asset. The more individuals and businesses that accept Bitcoin for transactions, the more its value is likely to increase, creating a positive feedback loop that can further enhance its legitimacy. Institutional adoption plays a pivotal role in legitimizing Bitcoin as an asset class. When major financial institutions, hedge funds, and corporations begin to invest in Bitcoin, it signals to the market that the cryptocurrency is a viable investment option. This shift not only boosts confidence among retail investors, but also encourages regulatory bodies to develop frameworks that support the cryptocurrency market. For instance, companies like MicroStrategy and Tesla have made significant Bitcoin purchases, demonstrating institutional interest and paving the way for others to follow suit. Looking ahead, potential future scenarios for Bitcoin's market capitalization are intriguing, especially when compared to gold, often regarded as a safe haven asset. Currently, Bitcoin's market cap is a fraction of gold's, but if Bitcoin continues to gain traction and acceptance, some analysts predict it could rival or even surpass gold's market cap in the coming years. This shift could redefine the landscape of asset allocation, with Bitcoin emerging as a digital alternative to traditional stores of value. As the market evolves, the interplay between demand, institutional adoption, and regulatory developments will be critical in shaping Bitcoin's future trajectory. Bitcoin faces several challenges and criticisms that hinder its acceptance as a mainstream currency. One of the most pressing issues is the environmental impact associated with Bitcoin mining, which requires substantial energy consumption. The process of validating transactions and securing the network involves complex computations that demand significant computational power, leading to concerns about carbon footprints and sustainability. Critics argue that the energy-intensive nature of Bitcoin mining contributes to climate change, prompting calls for more eco-friendly alternatives or regulatory measures to mitigate its environmental effects. Another significant challenge is Bitcoin's volatility, which poses implications for everyday transactions. The price of Bitcoin can fluctuate dramatically within short periods, making it difficult for businesses and consumers to use it as a stable medium of exchange. For instance, a merchant accepting Bitcoin may find that the value of the currency has changed significantly by the time a transaction is completed, complicating pricing strategies and financial planning. This volatility can deter potential users who seek a reliable currency for daily transactions. Real-world examples, such as Bitcoin's adoption in El Salvador, further illustrate these challenges. In 2021, El Salvador became the first country to adopt Bitcoin as legal tender, aiming to promote financial inclusion and attract foreign investment. However, the initiative faced significant backlash, with concerns about the lack of infrastructure, the volatility of Bitcoin, and the potential for increased economic instability. Many citizens remained skeptical, preferring to use the US dollar, which has historically provided more stability. These challenges highlight the complexities Bitcoin must navigate to achieve widespread acceptance as a functional currency in the global economy. In this discussion, we've explored the contrasting views surrounding Bitcoin and its potential as a financial asset. On one side, advocates highlight Bitcoin's revolutionary nature, emphasizing its decentralized structure, potential for high returns, and role as a hedge against inflation. Conversely, skeptics, including prominent figures like Warren Buffett and Charlie Munger, raise concerns about its speculative nature, environmental impact, and volatility, questioning its viability as a stable currency. Understanding both the benefits and risks associated with Bitcoin is crucial for anyone considering involvement in this dynamic market. While Bitcoin presents exciting opportunities for financial freedom and innovation, it also carries significant challenges that must be navigated carefully. As we've seen, the landscape is complex, with implications for individual investors, institutional adoption, and even global economies. We encourage you to engage with this content by subscribing to our channel, liking this video, and sharing it with others who may be interested in the evolving world of cryptocurrencies. Your support helps us continue to provide insightful discussions and analyses on topics that matter. Additionally, feel free to explore our related content, where we delve deeper into various aspects of Bitcoin, blockchain technology, and the future of finance. Join the conversation and stay informed as we navigate the exciting and often contentious world of digital currencies together. Thank you for watching, and we look forward to your thoughts and insights in the comments below.